We're going to dive deep into the mortgage rate and the Bank of Canada announcement today. All right, let's go. Keaton Kirkwood, how are you, my friend? First of all,
I'm doing well.
How's Alberta treating you?
It's been great. It's beautiful and sunny. A little bit of mosquito problem we're dealing with right now, but can't complain. But today's been a bit of a whirlwind.
Construction and mosquitoes, that's what you get out in the prairies at times, don't you?
It is, but there's no rush hour, so I think it's worth it.
That's nice. Well, first and foremost, I know that there is an absolute big, giant breaking news item that we have to cover here. Breaking news about the Bank of Canada announcement. But before we talk about the breaking news, I always like to start off with something that's probably more important than business and more important than real estate and all the kind of stuff, even though it's hard to say that there's stuff more important in real estate. Wanted to just congratulate you on the pregnancy of your second child on the way.
Oh, thanks. I am excited and a little nervous. Gonna have a little boy, so compliment the daughter we have. But it's exciting, and I'm trying to get as much sleep as I can right now.
Is it Carolyn or Caroline, your wife?
Carolina.
Carolina. Sorry. Pardon my. Just wanted to check on the pronunciation. So congratulations to you. Kids are amazing, aren't they?
Thank you.
And there's a lot of things that you and I can catch up on. And you just made a big giant transition over to moving out of, people rarely move from BC to Alberta. Usually it's people move from Alberta to BC, but there's an awful lot of people moving from British Columbia and Ontario to Alberta. And I want to schedule you for another conversation for you and I to talk about that. Is that cool?
Yeah, I would love that.
Yeah, I'd like to think about the thought process behind the reason why you made that decision, how it's been going so far, a lot of those kind of things. And the other thing I want to talk to you about too is I think you're doing an amazing job on your social media with your writing, how you're posting into a lot of groups and how you're supporting a lot of people. I think you're just doing pardon my language here for a second, guys, but you're doing a kick-ass job. Right.
I really appreciate it. It means a lot. It's the goal, so.
Yeah, absolutely. But today, as I mentioned earlier, we have, we have a breaking news item, and that breaking news item is the Oilers signed Evander Kane for another four more years, and that's the breaking news for people out in Edmonton. Is that not the true there, Keaton?
I'm still getting caught up with the local hockey lore, but. I'll take your word for it.
Well, or if you're out in Vancouver, the Canucks signed Brock Besser for another 3 more years. Or in Toronto, I guess if we're talking to Toronto people, they traded their goalie. So it's free agent day. So that's what's most important, is it not?
Yeah, no, I've heard Calgary's had a little bit of bad luck, but that's where I left off today with the hockey side. So.
No, but guys, as you know, we're all jest aside. We're talking about the Bank of Canada had its interest rate announcement that just came out today. It was a larger than thought. Everybody was kind of predicting 75 basis points, and it went up 100 basis points. So did the world end today? That's what we're going to dive into a little bit deeper here. Is we're going to talk a little bit about the interest rate changes, how that impacts you, and most importantly, guys, pay attention to this, to the group. I'm going to provide some resources tomorrow for a deeper dive into maximizing cash flow, longer term perspective, somebody who's been through 6% prime rate environments and what to expect over a long-term period. And I'm going to give you some more tools and resources. But today, what we're really going to do here today is I want to get Keaton on here, and I want to chat about the interest rate announcement and kind of what it means and what the impact will be. And we're going to talk from there. Okay, Keaton, I know there was a question in there somewhere, but what was the announcement today and how is that going to impact real estate investors?
So today felt a little bit like an M. Night Shyamalan movie. There was no secret that we were all expecting a rate increase. And the industry was arguing 0.5%, 75 basis points, 0.5%. And then, 1 in 30 people would say 1%. And everybody would shoo that person away. But today we had a 1% increase to the Bank of Canada overnight lending rate, which means that adjustable rate, variable rate, and HELOC, home equity line of credit products are going to go up by an entire %, which is a pretty big jump. And I think a lot more than many people expected.
Now, okay, so you said something pretty big there for starting point. Now, I'm going to put you on the spot, and it's okay if you don't have the exact numbers, but directional is fine. Now, so this does not impact people that have free and clear houses. Is that correct?
Absolutely.
This does not impact people that have fixed rate mortgages.
Absolutely.
Between free and clear and fixed rate mortgages, do you know ballpark how many, like what percent of the population have variable adjustable rate kind of lending products? Do you know offhand?
I don't know the exact numbers. I know historically it was predominantly fixed, but over the last 2 years, I do know that more Canadians than ever before have driven towards adjustable and variable rate mortgages due to low prime and good discounts.
Yep.
So I don't know the exact numbers, but I know more than ever before.
Yeah. So let's call it 30, 40%, because I think that, it varies. At one time, I think it was like in the like a 4% rate that people were only getting adjustable rate. But it was now, let's say a quarter of the mortgage product out there is probably in some kind of adjustable that got impacted by today's interest rate announcement. Now, did your DMs blow up and did your Facebook feed blow up today?
It's been a busy day. I've been doing a lot of work to make sure that my clients kind of know these changes are happening, because I'm really, really selfish and I didn't want to deal with today having been warned. So I've been trying to put the signals out for a while, but yes, it was still a busy day. A lot of people are concerned, and there's a lot of lost lambs wandering around right now.
Okay, so let's provide a roadmap for people. Okay, so let's really just break down a little bit of math as a starting point. So 100 basis points, 1 full point. So what did prime go from and to today?
So prime went from 3.7 to 4.7%.
Okay, so it's at 4.7. Now, what is the differential in payment from that full 100 basis points in general terms?
So it's about $52 a month. It's going to vary a little bit with your amortization, but about $52 per month per 100,000 you owe.
Okay, so if a person has a $300,000 outstanding line of credit or mortgage or something times 52, so they're looking at, what is that, like 150?
So it's a little bit different. Lines of credit. So the payment increase on an amortized mortgage is about $52. The interest increase is about $80. So lines of credit will go up about $80 a month as their interest-only payments.
Okay. So for example, like I have a lot of empathy for somebody that's maybe sitting in a variable rate mortgage and their down payment was financed through a line of credit. You potentially, pardon the term, got a double whammy, if you will. I could use a more graphic term, but let's go with double whammy.
Rock in a hard place, I like to say.
Absolutely. So in essence, somebody potentially could have gotten in essence, a couple $100 change in payment here today, quite easily.
I have some clients that have experienced over $1,000 a month change from today.
$1,000.
Definitely, there are some people, particularly in the Vancouver and Ontario markets, where this was a big change.
Wow. So that that's not. That is very fundamental in people's budgetary concerns and things that people have to look for. It's not one of those ones just close your eyes and la, 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 everything will be okay and everything is wonderful and all those kind of wonderful things. That is something that really you need to pay attention to.
Yeah, I'm sure some people want to jam out to some Bob Marley right now and have a little bit of the BC experience. But really, I think this is a time for awareness and being on top of things. You do not want to be flying blind in a market that's changing and shifting like today's is.
So you're saying a little bit of BC Bud will help ease today's...
I never said such a thing, Russell. You rascal.
I didn't hear that at all, by the way. Well, it is legal now, right? So, right?
Yeah, no, for sure.
Okay, so here's the thing. So it's happened. It's a change. It happened probably faster than more people were aware of. But to be honest, the Bank of Canada has been telling us this, haven't they, for a while, and they're probably not even done yet. What's your thoughts on the future for potential rate increases?
I don't know what the future holds big picture, but I do believe that as rates rise, it's going to get more and more difficult to continue to increase rates. So personally, I've been asking around some people that are smarter than myself and a little bit more of an educated background. The consensus seems to be that the Bank of Canada wanted to get ahead of the US increase coming up, and that likely this was very front loaded, and they're doing this so that they can slow the pace down, which while I really don't like the increases, I think it's a reasonable idea of let's just rip the Band-Aid off, get this over, and then we can slow down and let people have some stability.
Yeah, and I that's what I'm telling a lot of people right now is, it impact, it happened. It was almost like a big giant Band-Aid being ripped off. It hurt. It's still hurting. But you know what? We're just take a big giant deep breath. We're not going to end. The world is not going to end. Now let's exactly all together now, right? So now it's time to just get to work, right? There's some things that we need to do as real estate investors to make sure that we're shoring up the portfolio, that we're maximizing the revenue, we're decreasing expenses, and we're optimizing our mortgage products that we have in, extended amortizations, blend and extends, revert back to original amortizations, lots of different stuff like that. So,
and believe it or not,
go ahead, please.
I was going to say, believe it or not, I even have investor clients right now that have been, because discounts are just abysmal right now on rental properties of some lenders. I've actually had clients taking interest-only lines of credit on their rental properties, as the difference in rate can be as little as 5 to 25 basis points right now. And they're maximizing their cash flow. Instead of paying principal down on their rental, they're taking the money and paying down the non-tax deductible debt on their residence and kind of min-maxing things. And I think that this is the time where those who tinker with their portfolio and really adjust and stay aware of things will do far better through small incremental gains than those who kind of just set it and forget it.
Yeah. And here's one of the things that I believe it's going to happen. Now, this is going to be more of an Alberta phenomenon. Those in Ontario and Alberta and BC and different markets, you can, close your ears for a second. But the rental market is going crazy right now too. Meaning rental rates are going up as it gets a little bit more expensive for people that are on the margin to buy houses. They're pulling back on the home purchase and they're renting. They're renting longer. They're renegotiating. I couldn't believe how many people I've had for rental inquiries right now that are looking for 2 and 3 year terms. My answer obviously is no, but I haven't had that many people ask for multiple year terms because they just want to lock in their pricing right now.
I think now is definitely a time where stability is very desired and comes at a bit of a premium. But if you can offer stability, whether through rental product or through rates or as an investor, I think that it's something people are seeking right now.
No, I totally agree. And I failed to give you an acknowledgement there, and you actually dropped some fire there for a second. So hang on a second. That tip that you shared, and obviously when a fire happens, we get bombs that get dropped all the time, my friend, right? That tip that you shared about potentially converting a product into an interest only in the short term right now, I think is absolutely gold. And I never even actually thought about that. Because right now, mortgage pay down, cash flow is probably king. Cash is king of owning this. And, you can maybe forego 6 months to a year, maybe 18 months of principal pay down while you're just kind of weathering this interest rate increases.
Well, the big thing to remember is that your principal pay down in your rental property, while you see it as a negative number on the ledger from a cash flow perspective, the CRA doesn't. It's taxed. So there are tricks your accountant can do to offset it. But generally speaking, it's going to be taxed as income. So I'm a big fan if you can, instead of paying down the principal on your tax deductible debt, if you can pay down the non-tax deductible debt, you get the best of both worlds.
No, absolutely. Do you have any other tips and strategies and some gold that you're offering? So if a client calls you up right now, all in a panic here today, Keaton, what's going on? The world is ending. Oh my goodness. And that, that puppy dog breath, what's going on? What advice are you giving people? Yeah. What advice are you giving to people right now?
The biggest thing I'm suggesting for people is to go through and do a comprehensive personal budget. I think it's really important. You need to understand your personal situation. I've got a little one coming, so I'm thinking about it a lot. But understanding what are the fixed costs you must spend to have your life the way you need it. Understanding, I've got $1,600 a month that I can count on left over. And then understanding what that means with your home and your investment properties from a rate perspective. If you're destined for bankruptcy of 5.25%, you want to make sure that you're looking at locking in or diversifying or restructuring before you hit that point. And I think a lot of investors make the mistake of they don't worry about it because buying investment properties is good. As long as it cash flows, it's good. But things change and we have to adapt.
Yeah, and what's your feel? I'm and I'm going to put this out there publicly, which I have. I've actually been saying this for a better part of 3-4 months now. I believe interest rates are going to come back down again. If maybe not this year, but I think they're going to come down next year. If we're going to enter into recessionary times, which a lot of people are saying we're either close to it or might be getting into it. One of the reasons why the Bank of Canada is raising their rates so fast is that they have an ammunition that they could actually lower it again to stimulate and kick things going. What's your forecast if you look into the crystal ball on that topic?
So I don't even need the crystal ball for this one. I actually just threw a post up on Facebook about 10 minutes before we spoke. Bond yields have been dropping for the last 30 days, but surprise, surprise, banks haven't dropped rates. I wonder if it was in anticipation that the variable rates are going to go up. I think we're going to see a lot of people locking in right now. Like there's fear, there's concern, there's a lot of uncertainty. People are going to lock in. We're already starting to see calls that the non-bank lenders, the monolines, are going to be slashing fixed rates anywhere from 20 to 50 basis points. The banks haven't done it yet. So I wonder why that is, but I have a feeling that in the next week or two, we may see fixed rates start to drop anyways.
So it could be a very well, and I'm not that smart enough to really make predictions, but it could be very well that the Bank of Canada saw an exposure in having too many people in variable rate products. They're making variable rate not look appealing. They're going to change the fixed a little bit, and then all of a sudden people will just migrate over to the certainty and migrate back over to having that fixed payment, and then Bob's your uncle and kumbaya.
Yeah, it's certainly one possibility. The big thing to remember is that variable rates are driven by the Bank of Canada, and the Bank of Canada is driven by the economy, inflation, and monetary policy, whereas fixed rates are driven by 5-year bond yields, which mostly speaking are the stock market and the market as a whole. So it's very private. And it's interesting to see that bond yields have been declining over the last 30 days. And I think part of that was the reaction of the market realizing, okay, hey, governments around the world are increasing their overnight lending rates. The market priced it in, but now they're kind of finding their norm. So I think this is going to be a period of time where there's going to be a lot of opportunity for people that are aware and lock in or go variable at the right times or keep their options open with an interest-only line of credit.
Yep.
Whereas it's also going to be a time for a lot of regrets when people make, kind of emotional or rash decisions just based on a friend said something or they saw a newspaper article.
Yeah. And one of the worst things you can potentially do right now is a knee-jerk reaction. Like seriously, like I've heard things from people who have houses that they've written offers on and they're already, 3 months into it, they want to sell it already. And and people are not taking a perspective of long term. Like honestly, when you got into this, you were thinking 5, 10, 15 years. And now 3-6 months into it, you're sitting there going, I gotta sell it. It's just, today it's not cash flowing anymore. It's now negative, right? That's, guys, a knee-jerk reaction will never get you anywhere, ever.
I've always said that if I'm going to pursue an investment strategy personally, if I pitch that strategy in front of a movie theater, the dark night's out, and it's full of just regular people, adults, and I pitch my strategy, the less regular people think that my idea is a good idea, knowing that I know my stuff as a real estate investor and from a fundamental perspective. But the more the public goes, ooh, didn't you see the newspaper? It's a bad time.
Yep.
The more excited I get.
Yep.
So personally, and I'm curious your opinion, Russell, I really, really think that there's going to be some deals out there. I just actually saw someone snagged a property with a $750,000 vendor take back out in Ontario at a 3% rate. So there's opportunity out there, guys. While everybody else is, running to the bomb shelter, I think it's worth at least keeping an eye open.
Yeah.
Certainly not panic selling.
100%. The thing that I'm bringing everybody back to, just grounding everybody again, is yes, interest rates are changing. We knew it was going to happen. It couldn't stay at zero forever. It couldn't. It had to change. Plus also price increases, and a lot of markets have been going astronomically straight up for multi-years, and that can't happen either. You have to have a breath. It has to change. It has to get back to a little bit of normalcy. There's a pendulum that swings back and forth, right? Sometimes it's really favorable. Sometimes it's a little bit scary, favorable, scary, like lots of different things. But here's what I tell people is the housing market is so much more than just interest rate and price. The housing market is actually underpinned by a lot of economic fundamentals, GDP growth, in-migration, population changes, wage changes, infrastructure spending, political environments and areas, capital expenditures by companies coming in. There's a lot more things that drive a real estate market than just interest rates and price. If you're actually just looking at the price, you're actually looking at the tail end of it, right? You're looking at the tail, and the tail should not wag the dog, if you will.
I personally always try to look at real estate investing like a business, and you need to think of it from the perspective that, hey, you run a bakery, a real estate bakery, and flour was really, really cheap for a period of time. There was, a great harvest, and it was 20 cents on the dollar. When prices go back to normal from a long-term perspective, that doesn't mean that, close the bakery, life's over. And I think it's important that you look at your real estate portfolio like a business and make sure the fundamentals make sense and that it is still a viable business. But you have to accept that there's going to be good times, bad times, and the in-between, and you're in it for the long run.
No, 100% agree. With a quick pivot question here, and I think it was a couple months ago that you brought out just a wonderful article throughout the Facebook world about variable versus fixed. And I think the premise was on there that it had to be like 10 quarter point increases in order for it to make sense in order to go fixed versus variable. If you were to write that article today, after today's announcement, how would you write that article today?
So the gap is definitely closed. So there's kind of two thoughts to this. One is that we need, they've started doing bigger leaps. So there's been bigger jumps than 0.25% increases. So roughly speaking, we're going to need to see somewhere between 6 and 8 increases, depending on the frequency of 0.25%, for costs to break even. But it's important to note that that's assuming it's sustained. What I wonder is, are we going to see rates increase, then decrease? The other thing you have to ask yourself is that, and I personally believe in this, the more they increase rates, the harder it will to further increase rates. I think we can all agree that there's some sort of breaking point in any real estate market that has debt, where if interest rates hit that certain level, there's going to start to be a certain degree of damage. And as they rise beyond it, the damage will get worse. So personally, I think that while many people are going to be very scared of variable right now, I think it's more of variable as a choice today moving forward is still a reasonable consideration. And the fundamentals of the penalties are 5 to 10 times smaller are a huge component of it, particularly as a real estate investor. So I don't know about you, Russell, but I tend not to sell my investment properties based on renewal dates, but more tenants, fundamental issues, whatever's going on with the market, not so much the renewal date.
No, I totally agree. And to be honest, now hindsight's always 2020. The best time to take the fixed rate would have been in like March, April, May, June of 2020 would have been the best time to take a fixed rate and lock in for 5 years if you knew you were going to hang on for 5 years and you didn't have payout penalties. Like some people I know locked in for like $1.40 or $1.49 or 1.5% type thing, right? So, but the only thing we can do is today, and what are the course of action today? I still believe variable is still the road to go because it's going up. I have a feeling it's going to plateau for the next little while. We're going to get used to the new payment rate. And I think that there is a great chance that it can come back down again. But I'm not going to bank on that. I'm not going to hang my hat on that forecast. But I have dollars to donuts. I think it's going to come back down again.
For what it's worth, I've got 2 investment properties in my primary residence that I just bought. They're all variable. And I'd be a liar to say that I haven't thought about it. I haven't stressed about it. Today, you better believe I was like, I wish I would have taken fixed in February. But at the same time, I'm a firm believer you have to make the best decision you can based on the information you have at the time. And I know that it was the best decision I could have made at the time based on the information I had. Hindsight, sure. But we all know we should have bought Bitcoin 9 years ago. It doesn't change the fact that at the time it maybe didn't make sense. So
yeah, you can only operate and go forward with what you have to, with what you're presented today. Now, the other thing you had mentioned that I saw on one of your posts just recently was talking about, the mortgage balances are significantly different. The average mortgage in British Columbia and Ontario will be significantly different than the average mortgage in, Manitoba, Saskatchewan, and Alberta. And I think that's going to make the, affordability differential even greater again. And you know what? We're probably going to still see more people moving and migrating out to the prairie still. What's your thoughts on that?
I agree. It was one of the big factors. It wasn't the only one, but it was one of the big factors that led to me moving to Alberta, was really trying to get a couple steps ahead mentally of what I think regular people are going to do. And it's a rock and a hard place situation. If you own a home and you can't afford to own it, or you're considering selling and renting, yeah, if you've got a lot of equity and you can sell and take hundreds and hundreds of thousands of dollars, okay, maybe it's a viable choice. But assuming that's not the case, renting certainly isn't a whole lot cheaper. And we as investors know, because we look at the numbers, yeah, some markets don't cash flow super, super well, but they still, we're not talking $5,000 differences here. We're talking it's $4,000 a month to rent, it's $4,800 a month to own. As an investor, we're not going to buy that, but $4,000 isn't a whole lot cheaper than $4,800. You're not saving a lot.
Yeah.
So I think we may see prices decline in some markets, but we're going to see prices decline because costs rise, which I think is going to put even more pressure on rents, which is going to put even more pressure on renters, which I think is going to put a lot of pressure on certain expensive markets.
Yeah, I agree. And I'm, just personally speaking here, we were just, Crane and I the other night, we're having a conversation about, with the kids, and we're wondering about what the kids are going to get out. And, we have kids that are getting to adult kids, and they desperately want to go out and be on their own, right? And they don't want to live in the basement forever. And, in some cases, they actually even have the down payment sitting in the bank. But then they sit there and go, well, geez, a townhouse in our neighborhood and areas costs $900,000 to $1 million. And they go, well, even if we put $100,000 down, how are we going to afford a $900,000 mortgage? So something has to give, right?
As a family looking to try to get a home, and we compared the options we could get, and for $700,000 we found a house on 10 acres 12 minutes from the city, from Costco Superstore. There's a lot of options out there the moment you open up your mind and you consider other markets. And I think that we're going to see a lot more of it, because as people do it, it becomes a little more normal. It's a little more talked about, and it is happening. I have dozens of clients that are making the move or considering making the move. And I've heard from dozens of realtors that they're getting more inquiries than they've ever had before. It's not just Alberta. And
are you born and raised British Columbian?
Yeah, I was born in Surrey, grew up in the Okanagan. Now, I had a little bit of an insider's advantage. I moved to Alberta when I was 20 to work in oil and gas for a couple of years before moving back to Vancouver. So unlike everybody telling me about the winters and to be worried, I had experienced the winters before. Yeah. But BC is where all our family is. Like, we left kind of everyone and everything, but it was the right choice for us.
Yep. And it just comes down to, with today's technology, and I imagine Wi-Fi was probably one of the biggest concerns that you would have to have, is because you need to have good Wi-Fi in order to do what we're doing, plus also be a mortgage broker, and your clients are probably national. You have national base of clients, probably primarily out here in BC, but you potentially open up a laptop and do this business anywhere in the world, really.
No, absolutely. It's we got unlucky. We are in the gray area where we are too close to town for Starlink, and we are too far from town for really good internet. But there's options everywhere,
right?
And it's top of my list though was internet.
Okay, I spoken like a good
number
nerd.
One.
Yeah, spoken like a good nerd. Right? Business. It needs to be. What did they call Edmonton's becoming a Zoom town? Not because it's moving fast, it's just because that's where people go to do business, and they do business on Zoom. That's what we're doing right now, is having a conversation over Zoom right now. Absolutely. All right, so back to the mortgage thing. So best advice you would be offering somebody here today? It's the afternoon of the rate increase. If you're writing an article to go out again tomorrow, which you've been doing pretty much on a regular basis, what's the next flavor and tone of the article and advice you're giving people?
My best advice is make your decisions slowly because it's very expensive to change course. And fortunately, bond yields are declining right now, which means there's a downward pressure on fixed rates. So it means that there's a week or two to take your time, take a breath, gauge the fallout, and then plan a course of action and execute on it. And don't just act. Because some people will, but I bet you a lot of those people will regret it.
Yeah, I love that thought process is make your decisions slowly, take a deep breath, make a pause. And I'm going to add one thing to it. And I'm going to add is reach out to your community, reach out to support, reach out to people that have if somebody tells you they've been through a market that has 6% interest rates or even higher, they've been through these marketplaces. Reach out, get the perspective from the people with a little bit of the gray in the hair, and people that are professionals like Keaton here that can steer you in the right direction. And just even that one tip you gave earlier could be an absolute gold nugget for somebody about potentially just pivoting from, a mortgage, variable rate mortgage into just maybe even interest only in the next little while. Plus, or there's a whole bunch of other mortgage tools in the box as well.
I'll share one.
Yeah, please do.
At the end of the day, as interest rates rise, the cost of your mortgage is going to go up. If you can find the ability to make your mortgage tax deductible, you gain an increasing benefit as rates rise. And I assume that most of us are real estate investors. I'm not here to advocate go start dumping your money in the stock market or go buy more properties, but look up the strategy cash damming. There's a way that you can take the gross rental income from your properties, pay down your non-tax deductible mortgage on your home, then reborrow the expenses to cover your investment properties. You're not taking on any new investment risk, and you can create tens or hundreds of thousands of dollars a year in tax deductible debt and reduce your non-tax deductible debt. I had a client that I analyzed this for the other day. Year one, he saved $900. Year two was $1,600. Year three was $3,200. It went all the way up to $10,000 a year after year, I think it was 9. And then moving forward, he was going to save $10,000 every single year, slowly declining as the balance fell down. But it was a total savings of about $180,000. So,
well, I'm sensing another conversation for you and I, maybe a webinar to educate the community and get that message out a little bit. And I know that you and Robinson Smith and the team of guys have been doing a lot of that and doing a really good job. But I'd love to introduce you guys out to my community as well, because I think there's a very big need for this as well. So are you up for bringing a little more fire there on another call, brother?
I would love it. It's always fun. Well, the energy is amazing.
Only if you promise to bring a bomb or two.
I promise.
So where would if somebody wanted to get a hold of you, reach out to you, where would somebody be able to, what's an email or a phone or a website? What's the best place to get a hold of you, Keaton?
You can find us at www.kbmortgages.ca, or my email is Keaton, Keaton, @kbmortgages.ca.
Perfect.
You can find me on Facebook. I'm pretty friendly. Just add me.
Nice.
Send me a message if you can, though. I get about 100 requests a day, so I try to screen through who actually wants to connect with me versus the bots.
Nice.
But happy to help.
Oh, there's no bots? Didn't Elon Musk just determine there's no bots on Twitter?
Tell that to all the beautiful young women that are adding me and then sending me messages asking about how my day's going. I'm like, Then the crypto pitch.
I don't even get that. So I must be doing something either right or wrong, I guess. Anyways, so good. So I appreciate you shedding some light on this. So bottom line, everybody is, it's not the end of the world. Take a big, giant, deep breath. Don't make any rash decisions right now. Reach out to your experts and your professionals, and there are always options. Always. Anything else you'd like to add before we sign off to here today, brother?
Yes. Trigger points. So some of us have
I had
an
entire question I wanted to talk about is adjustable rate and adjustable payment mortgages too. So you triggered a thought for me.
So I'll take a step back then. We'll start at the foundation.
Yeah, let's just rewind. We'll do a little rewind. That's my best impersonation of a rewind.
So the industry makes a mistake, in my opinion, of calling variable rate mortgages. I want you to think of it as floating rate mortgages. There's three types. There's home equity lines of credit, there's variable rate mortgages, and there's adjustable rate mortgages. I think we all know HELOCs, generally interest only. There's some rules about them. We all love them for down payments. The two I want to talk about are adjustable and variable rate mortgage. Now, adjustable rate mortgages, your payment fluctuates as rates rise and fall. So you stay on track for your amortization. When the interest cost goes up $100 a month, your payment goes up $100 a month. Pretty straightforward. It's good on your residence. It can be a little scary on a rental property. The variable rate mortgages, though, they're kind of a wolf in sheep's clothing. They have some benefits, but you have to be aware of how they work. So variable rate mortgages have a fixed payment. I want you to think of them as like a fixed payment variable mortgage. The interest cost rise and falls, but the amount of debt you pay down is going to move with it. So your payment is fixed at, let's say, $1,400 a month. We've seen, and in normal markets, it's great. Rates go up a little, go down a little, whatever, off you go. We've seen a lot of sudden increases. The government's kind of shocking the system and getting caught up. What happens is your payment is fixed. But if the interest rates rise quickly to the point that the interest exceeds your payment, there's something called a trigger point. It's almost as scary as it sounds. Trigger point is going to be different from lender to lender, but the moment your payment or the moment the interest exceeds your payment, things start to happen. Some lenders will increase your payment $20 a month and you ride off into the sunset. Other lenders will say, hey, halt, Russell, good news, bad news. You didn't cover the whole interest, so we're going to change your payment. Yeah, we're going to get you back on track to amortization. We're going to adjust based on the interest rates. Your payment goes up $1,200 a month overnight. So it's going to vary depending on the lender, the product, the mortgage. But it's important to be aware that if you're in a variable rate mortgage or something called a trigger point, and you're going to want to start asking questions. Particularly if you got your variable mortgage when prime was 2.7 and you were getting those sexy rates in the 1% range, you need to be aware right now. You need to start making calls. It's not a panic thing. It's just realize that there could be some changes to your payment shortly, and you probably want to get ahead of it and understand at what point these changes will kick in.
Yeah. And I even heard something interesting that you mentioned that. I heard that it was a bank that color blue, think the color blue, I'm not going to say which bank, but it was a client that actually had a line of credit. And I think he had unused money in the line of credit. And the blue bank contacted them up and said, if you want to keep that line of credit access to it, we're raising your rate. So they literally almost twisted his arm and said, they threatened to pull his line of credit if he didn't change his payment on his mortgage portion of it. And so his comment was, holy moly. So it was a little bit of a rock and a hard place where he goes, access to the capital is more important than the price. And his payment went up, I think, close to $700 a month.
I think an important thing to know is that the bank's not out to get you, but they're also not your friend. Like, they're a financial institution, they're a business. The bank is going to do what's best for the bank. When you work with mobile specialists at the bank, they're bank employees. They have no obligation to do what's best for you. They will do what's best for the bank. Now, hey, I'm not saying they're not good people. They're still going to try to help you, but they don't have a legal obligation, and there's a different lens. Brokers are fiduciaries for their clients. We legally have to do what's best for our client, not for ourselves and not for the bank. And we have to be able to defend it in court. So it's important to kind of know who you're getting advice from.
Yep. 100%. And, it's almost like I don't want to end on a really big, giant, scary note for everybody, but bottom line, guys, is some changes have happened. It's a little bit of some stormy weather. And gang, this is why we as real estate investors build up our resilience. And this is why we tackle tough things. And this is why when these things happen to, say, our investment partners, we take a leadership role. Right? We get in front of it. We be proactive with it. We handle it. Margins will be compressed, but we find other ways and we pivot each and every one. So honest to goodness, some people sit there and go, well, I just want it to be smooth sailing and I want it to be easy. No way. you don't get to see what you're capable of when everything is just sunshine and roses. When things get a little bit bumpy and a little bit choppy is when you start earning your money and when you start earning your keep. And everybody who's thinking that this is just going to be an easy game is gone and they're out the door, and you're one of the last ones standing, and you have the greatest opportunities when the sailing gets good and nice and flat sailing again.
Well, I'll share this. It's something I've learned in the mortgage industry. I think, as most of us know, there's been a lot of rule changes in the mortgage industry since the early 2010, 2011. Every single time there's been a rule change that has made things more difficult, more challenging, made my industry harder, and your job as an investor more difficult. We focused on adapting and overcoming and just accepting. It is what it is. It sucks. I'm not going to complain about it. I'm just going to figure out what is the new best solution. Every single time it's happened, it's led to us getting busier. And I think the same is true as real estate investors. There are going to be those that are going to throw their hands up in despair and reminisce. But if we treat this like a business and we just accept it, okay, it sucks, but what do we do moving forward? And we treat this like a long-term thing, and we just do the best we can given any set of circumstances. You will do well. You will succeed. You will find opportunity, and you will surpass the people that either just go la, 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 or those that just reminisce.
Yep.
It is what it is. It sucks, but let's move on. The world's not over.
Change is an incredible opportunity, and a little bit of amen, some fire to that, my brother. Oh, wrong button. How about this button? There we go. Keaton, well, it was good catching up with you. And you know what? You and I are due for another long form conversation. I want to get you back on the podcast, and I want to get you out there, and I want to tell a little bit of the deeper story. There's a deep story there that I think a lot of people need to hear. And there's a pretty cool story under there of somebody who's overcome an awful lot throughout the years to become a successful professional. And honest to goodness, you haven't even started to scratch the surface about what you are about to come. It's for you. If you look under the iceberg analogy about what's underneath the surface, about what's there, that's you. You have a lot of upside potential, and I can't wait to see what's the next step for you, my friend.
I sincerely appreciate it, Russell.
Yeah. All right, guys. With all that being said, if you have any questions, leave it in the comments below. Make sure if you are part of this group, ask your questions. More resources are coming. And also, if you're on the YouTube channel, if you do see this eventually on a YouTube or podcast, leave a comment, leave a review, and by all means, please share it out. Okay. Thanks, everybody. Have a good night. Bye for now. I sure hope you enjoyed this in-depth training video, and I applaud you for sticking around right to the very end. I believe in people that show up, put in the work, put in the time, and effort should be rewarded. If you're interested in taking the next step, if you're interested in going deeper and mastering what you just learned about in this training video, I encourage you to check out the Raising Capital Academy. So if you have found that you've received some value from the YouTube channel, or maybe you've listened to a podcast, you're only scratching the surface. That truly is just 1/10 of 1% of all the content and materials that have been created that are waiting for you on the other side. So I encourage you to check out the Raising Capital Academy. There's more than 100+ hours of video content, audio content, exclusive training material for those that are interested in taking the next step, those that are interested in going towards mastery, those that are interested in moving forward with velocity. So I would encourage you, wherever you're watching this video, around this video will be a link where you can check out all the details of the Raising Capital Academy. After you've checked out all the details on that page and you're interested in moving forward with velocity, click on the link that will take you towards the application. This is by application only. This is a community program and is for serious action takers only. So if you want to step up your game, if you have goals and dreams and aspirations for more, if you'd like to make a difference in the financial futures of the most important people in your life, I highly encourage you to check out the Raising Capital Academy. Click on that link and you'll be taken to the next step in the process to see if you qualify to take the next step forward for you. Hope to see you on the other side. Bye for now. Hey, I sure hope you enjoyed this video. If you are interested in moving forward with velocity, if you're interested in being a successful real estate investor, only 2 simple next steps from here. Number 1, below where you're watching this, there will be an opportunity for you to subscribe. And over here will be a hand-selected video for you to keep moving forward. Continue your journey forward. Just click on over here for that hand-selected video for you, and we'll see you on the other side. Thank you very much.